Okay, everybody, it's Kevin Wadsworth and Patrick Karim here from NorthStarBadCharts.com, and with us today we have Andy from Finding Value Finance. So I'll let Andy introduce himself. Good to see Andy.
Yeah, well, thank you for having me on this channel. I appreciate it for the invitation. And my name's Andy. I'm from Colorado. I'm an engineer by trade, and I got sucked into the finance group for we'll call it financial freedom purposes. And then I started watching your guys' channel and on YouTube and others alike, and some of the more controversial channels out there. I said, you know what, I got to start my own channel and set things straight, at least for the way that I see it. So thank you for having me on the channel. I do have my own channel. It's called Finding Value Finance, and let's get into it.
Well, yeah, it's like it's some I forget, somebody in our, I think on our website, Kevin, that said that, oh, you got to go check out Andy's channel, and he put a link to one of your podcasts where you found this relationship between real estate and gold, and I was just, holy Moses, man. And then for months I tried to find your email to invite you, and look, it just didn't happen. But I'm so happy like you reached out, and I hope today we get to cover at least that real estate and gold relationship there, which I think I think you're the only one I've ever see that correlation there. Super intriguing.
Yeah, I'll step through it. Maybe I can share something here.
Yes.
So we'll share it here. And that under, hopefully I'm doing this right. Show participants.
I'll stop my camera, Kevin. I think there could be a...
There's a little bit of bandwidth issue. I'm not sure if it's Andy's end, but we'll just soldier on, and hopefully it'll be fine. I'll switch my camera off and let Andy sort of talk through his slides, and
yep.
If Andy can get his slides loaded.
You guys can see it?
Hold on.
Yeah.
It should be.
Okay, I just see Kevin now.
I'll put my camera back on just so that the folks can at least have something to look at whilst we're talking. And
mine says I'm sharing. It says Teams Microsoft is sharing the screen.
Yeah, it's sharing now. It's just taken a while to appear. So
you see it or no?
Yeah, we can see it now, Andy. That's fine. I'll put my camera back off, and we can just carry on talking. So what are we looking at here, Andy?
Okay, so all right, so we have at the top section here is the new privately owned housing unit starts. That's new homes being built for residential real estate. I got this from Fred, and the average is this line going across here in the green. It's about roughly 1.4, 1.5 million new homes being built is the annual average. And this is for the United States. We have this average, and what we're looking at through the housing starts is the real estate cycle. We've got a recession when it comes down. We have a recovery phase when it's going up and underneath the average. And we go into an expansion phase as we go above the average. And when you think about banking or bank lending, and credit expansion and credit contraction, this, I think, is the driver of where that credit expansion and contraction comes from. And if you look at the chart, there's dark gray lines on this chart, which signify recessions over time. And if you notice, whenever the housing starts go below the average, almost every time we have a recession. And a recession is nothing more than a credit contraction. It's a deleveraging moment. So by looking at the housing starts, and whenever they go downward and below the average, you start to see credit to contract, and you get a recession. So you get a contraction in credit, recession. We have one that didn't. We have another one here, recession, another contraction here, recession. Recession, recession, recession. Every time this comes down and contracts, we get these recessions in here. And the only time it didn't was the dot-com bubble. And those are blowout kind of deflationary deleveraging crashes. And you can obviously see 2008 here. And one thing I want to point out with this housing starts is in the 1970s, we had a very large home boom or home start expansion in real estate, which is very inflationary. So we had a big move in the 1970s to 1973, 74. We had a little dip, kind of mid 1975-ish. And then another big expansionary boom in real estate, which is inflationary. We can also see that it's inflationary in the late 90s to 2008. That's that another housing expansionary phase. And then recently, from 2020 onward, we are entering a new expansionary phase of real estate. And one thing I want to note on this housing starts that I've noticed is looking back in history, we've got these small kind of contractions and expansions over time. And what caused this boom over here in the 1970s was the baby boomers coming into home buying years. This chart is driven by demographics in the United States. So the baby boomers came about, they were born in the 40s and 50s, they came about into home buying years. And that was the expansionary phase in the 1970s, was the baby boomers coming into home buying years, buying homes, spending more money, and having that expansionary credit expansion leveraging up phase. After that phase, it was a smaller demographic. It was Gen X. So we had this smaller demographic come through after it. Now what's coming recently is the millennials, which is a little bit larger demographic. So I think we're going to go into another expansionary phase because of demographics, and the millennials being a little bit larger demographic than the generation before it, which is Gen X. But there's also something else that's piled onto the housing starts and problems in real estate, at least in the United States. This last crash had some problems. We overbuilt and went into a hyper supply phase in real estate over here. We restocked inventory. And what happened was we crashed. And a lot of the homes that were built in this area foreclosed on. So after that crash in 2008, we not only replenished our inventory with new home builds, we also had a bunch of foreclosures that came onto the market. They came onto the market, and the new home builds, which is this line coming all the way down here, had a problem because they were competing with foreclosures and they weren't building enough new homes. And what happened was, and you can see this red area under the curve signaling that we were in a deficit, we weren't building enough homes. They were competing with foreclosures. They didn't build enough new homes, and that created a large deficit in the real estate market. The deficit right now is about 5.5 million homes. So we are underbuilt in real estate in the United States by 5.5 million homes. And you're probably wondering what these circles are. So what I'm trying to do is I'm looking for an alignment. I'm looking for an alignment in demographics, real estate, and valuations in terms of assets. So when we look to the right here, and I'm going to go over what those circles are in a second. This is the commodity index to S&P 500 ratio on the right here. And it's favorable to buy commodities when they're cheap against other assets. This one in particular is the commodity to stock ratio, or S&P 500 ratio. So you want to buy commodities when their ratio is cheap, and you want to sell your commodities when it's expensive. Or vice versa, you want to buy your stocks at the top here and buy your commodities at the bottom, however you want to look at it. But what we have coming up recently is we've got a buy signal for this ratio and this valuation for commodities against stocks. And what I did is I took the buy and sell signals off this ratio chart for commodities and stocks. So this is a buy for commodities, sell for stocks, buy commodities, sell for stocks, and a buy commodity. And I overlaid it on the housing starts, which is demographic driven. And we'll get into demographics on another slide to show you what's coming. But this is the buy signal and sell signal of the ratio of this chart over here, of this guy. So we've got a buy signal on valuation, and we went into an expansionary phase, and that ratio compressed, and then went to a sell signal when the housing starts went back below its average. We had another buy signal in 98 and a sell signal in 2007, 2008. And now we're throwing another buy signal for commodities with the alignment of the housing starts aligning and with the demographic aligning in the millennials. So the alignment is there, and this is what I've noticed in terms of overvalue, I should say, with increasing valuations of commodities, they revalue themselves during these market conditions under the expansionary phase of real estate is what I've found. And the expansionary phase, what I have here underneath it, is the M2 money supply and inflation. If you look at the M2 money supply and how this reacts to the housing starts, and if you were to overlay these two charts, you can see that the M2 money supply correlates very, very well with the expansionary phase of real estate. So from 70 to about 74, you get this expansion in M2 money supply. Then it declines when this housing starts to decline. And you can see it go up and down, the M2 money supply, very similarly, almost to the T, as the housing starts. Inflation, which is in the red line here, is just lagged by a year or two. So when you look at what's coming ahead of us, we've seen this, and there is a bunch of money printing that happened from the Federal Reserve that skews this line after 2008. They did a lot of money printing in the 08 to 2011 era here. So it's not perfectly matched when you get past about 2000 because they've done a lot of money printing, the Federal Reserve. But if you look at to the right-hand side, we're going into an expansionary phase of real estate. We've got the M2 money supply with their money printing along with it, launching and lurching higher. And the inflation is just lagged by a year or two. So this inflation line's coming up, which mimics this line right here. And I don't know exactly what's going to happen with this much money creation right here, but that's what's coming next. And what I call this is the floodgates for credit expansion in the real estate market are open, which means this money is going to get into the hands of people as we progress this expansionary phase of real estate forward. They created currency earlier in these areas back here, but the real estate market, those floodgates weren't open because we weren't in an expansionary phase of real estate. So all of that QE and money printing that happened in the past under these conditions where we were in a real estate recession or recovery phase, that money couldn't get out to the general public. It couldn't really raise the inflation very much. And you can see that some of these went up quite a bit, but the inflation rate remained pretty tame. The difference here between 2009 to 2010 and when they were doing all that money printing back then is that we've got an expansion phase of real estate. That's the difference in how that money is going to flow into the system and create that inflation. Now, I'm going over the values here. And what we want to do is we want to see this move higher. We want it to see it break that bottom and start moving up against stocks. And what we've seen in the CRB to S&P 500, this is a real-time clip of it, is we've broken our downtrend line. In 2020, we broke it late 2020, early 2021. We were coming up and we were breaking that trend, the down trend line. And we created another pattern, which we then broke to the upside here recently. And what this is we've got a higher high. So we have a first high, we have a low, we have a higher lows, and now we just created a higher high, which This here, by definition, is a beginning of an uptrend. So the CRB index versus stocks just started a new uptrend in that ratio. And that means that commodities will most likely outperform stocks here going forward. What else I also have here is we're looking at the demographics. And I know some people on YouTube, they think that we have a smaller demographic that's coming in home buying years. I just wanted to clarify this. This is in the age in 2020. This is the population in America. And right now, the median age for a first-time home buyer is around 33 to 34 years old. And what I want you to see is the trend of it moving higher in terms of population that is coming into home buying years. And that we're entering this expansion phase with very little inventory, which by definition, if you're entering an expansion phase, you eat through all the inventory. And we're entering it with a 5.5 million home deficit. And that's how fast and how many families are being created over time. And we've got a bunch more that are coming right behind age 33 and 34 into home buying years. So the largest age cohort that is coming right in front of us. And what that means is we're just entering an expansion phase. Our inventories are depleted. We have a 5.5 million home shortfall. And the largest age cohort with a very large demographic that's coming up in the home buying years is right in front of us. And we have the CRB index breaking out against stocks with the valuation signal throwing a buy signal. So what I call this is alignment. You've got your market conditions that are aligning with your valuations. And what I'm doing is I'm going in and I'm buying commodities, all different sorts of commodities. And one chart that really gets me going here is the gold to monetary base ratio. And what we're looking at here is gold in relationship to the monetary base. It's that ratio. And if you look at the past, when we were under a gold standard, the average was roughly 3.5. And they overprinted in the 50s and 60s, and they were cheating the system. And what happened was when the baby boomers came into home buying years and that inflation came into the system, what inflation does is it puts pressure on interest rates to go up because inflation is greater than the interest rate as inflation starts to ramp up. It puts a larger and larger real negative yield on bond holders. And when interest rates start to go up, not only are they losing purchasing power on their bonds because of the real negative rate, the interest rate is increasing, which is putting pressure on the prices to go down as well. And what we see is we see the alignment coming with inflation. We see that there's a larger demographic coming, which is coming into home buying years. The fractional reserve lending, which means that when they make new loans against new homes, it expands the money supply. Those are all expansionary credit expansion. So the new loan against a new home is 100% expansionary. And when this inflation comes into the system, the bondholders are going to have to do something with their money. They're going to leave bonds. And when they leave bonds, the next best asset they're going to buy, which has low risk, is going to be gold. And when gold accounted for the money supply, it happened in the 1970s. It went from 70 to 1980 when it was freely traded. And we had an inflationary environment where people didn't want to hold bonds because of rising interest rates. So when you have high inflation with high or rising interest rates, people are going to rotate their money out of bonds into gold. And that was observed in history from 1970 to 1980 under those market conditions. You can even see mid-cycle the pullback. Remember that pullback at about 74, 75. Here's your pullback in the housing starts of 74 and 75. Here's your pullback in the M2 money supply because of the housing starts. And here's your time delay in your inflation rate, which is a year or two delayed. What I'm expecting going forward is we were in that big, we'll call it disinflationary period, the Gen X cohort, which is this group over here, which is a very low or small demographic area. We went into a bear market for gold, so to speak, in relationship to the monetary base ratio. And right now, with the alignment of the demographic, with the alignment of the expansionary phase and the 5.5 million shortfall, if and when interest rates go up in this high inflationary environment, I think you're going to see gold basically account for the monetary base and this ratio reaccount for itself over time. So I think we're going to have a scenario like the 70s where they printed a bunch of money before it. We had a demographic that came into home buying years. And during that time frame, even if you have home buying years, they like to spend a little bit more money. So the velocity also either maintains itself or kicks up a little bit. And during those market conditions, gold reaccounts itself for the monetary base. And I think this ratio is going to come back up quite dramatically.
Well, whilst you've been saying all that, Andy, I mean that's it's amazing stuff there to see how it all ties in together and where this roadmap is taking us. And whilst you've been sort of talking about that, I've been looking at my chart that I posted a little while ago. I posted a few times of the Fed funds rate. It goes back to the 1970s, and it shows a very clear, what you've just been describing there is very clearly reflected in the Fed funds rate as well during the 1970s. And then from 1980 onwards, the Fed funds rate just declined and declined and declined in a very clear sort of channel. And it's kind of made a bit of a false breakdown. It's the Fed funds rate, reaching down into negative territory, into sort of unsustainable kind of lows at the moment, somewhere down near, I don't know, -5% or something like that, the overnight interbank lending rate. And that's a kind of sign of stress in the system. And whenever that's evident to that extent, and we've seen huge sort of drops in that particular rate, it's a sign to me that just looking at the chart and looking back over history, that we're about to see some kind of rapid reversal to the upside, which kind of ties in with the sort of the inflation that we're seeing around us, and commodities starting to appear. We all know what's been going on with gas, electricity prices. I mean, here in the UK, they're up something like 800%, 900% in the last 18 months, and are at very high historical levels. In fact, all-time highs that are going to end up causing huge problems as the costs get fed through the supply chain. But it really does. I mean, I agree with everything you said there. It does feel to me as though there are some very, very big parallels to the 1970s, and that this whole era over the last 50 years, really, of declining interest rates, declining lending rates, mortgage rates, and all the rest of it that we've got used to, is at risk of coming to a very abrupt end. Don't know what Patrick thinks about it.
Yeah, well, I just see that tidal wave, that M2 money supply. I see those as waves, and that black line, it's super scary what's going to happen to the red line when it starts. And it's probably like in as large in the age cohort, like the home buyers coming in, that red line, that inflation red line below the money supply, when it starts accounting for all that monetary imbalances, the inflation coming in we should have a crazy wave, just like the 70s. We're going to have waves, like maybe 1-2 huge waves of inflation coming in the next decade there. There's the charts are pointing to that. I've never seen the population one. That's pretty, I'm going to have to get my hands on that type of data, because that's pretty telling.
I think the demographics are important, but I've got to ask Andy the question that I ask probably most guests at this point when we start talking about inflationary forces in the 1970s comparisons. Of course, in the 1970s, it was possible to raise interest rates to whatever it was, 15 or 20% to effectively kill inflation. And of course, the pain point, if you want to call it that, for interest rates is way, way lower than 15 or 20%. So if we start to see inflation running away to 5, 7, 9, 10% or more, I haven't quite worked out how the United States can raise interest rates sufficiently to close that gap and effectively knock inflation on the head. How, if we've got a debt, if the United States has a debt burden of 30 trillion, 35 trillion, 40 trillion, and that's not taking the unfunded liabilities into account, where's the tool in the box to raise interest rates to control this? Because of course, if interest rates drop at 4 or 5%, even 4 or 5%, which historically isn't very much, but that would that would destroy the ability of the United States to meet its debt obligations. So how do you see this ending?
Yeah, that's the entire problem. That's the $1 million question is how are they going to slow this down once it gets going? And my answer is, I'm not exactly sure. I don't know if they can slow this down.
No.
And that's why looking at the precious metals is such a undervalued spot to be in right now, because if you look at it, when people lose confidence, when we can't see a solution, they might be handling what I would consider to be maybe a predicament where there is no solution. You've got to start handling outcomes, and that's where it gets a little bit scary. So if you look at this gold to monetary base ratio, and it's basically the cheapest it's ever been, you can buy physical gold, physical silver for what I would consider to be some of the cheapest prices ever. And if you know that this information's coming with demographics, inflation, and the expansionary phase, I would be a buyer of physical metals, because when people figure this out and they lose confidence, what could potentially happen is people get scared and then they start buying something because they have to, not because they want to. So that's what I'm afraid of, and I don't have a good solution for the Fed on how to slow this down and what to do. But you could come up with solutions to slow down the rates of homes being built. You could cause supply chain disruptions. You could look into other ways to slow the travel of humans. You could figure out ways to do stuff like that to try to slow down this movement, if that makes sense.
Yeah, like price control. They've tried that in the 70s, and I believe in England they're doing it right now, right, Kevin, on certain things?
Well, as much as price manipulation might be attempted, and it may result in some short-term effectiveness, every time I've seen it attempted in the medium to longer term, it just makes things worse. All this kind of tinkering around the edges when you're not actually fixing the problem. It's like trying to fix the hole in your roof when the house is getting washed away. What's the point, really? I suppose it can buy you a little bit more time, but it doesn't give me any confidence in the problem being solved. I just wonder if there is some master plan to completely change our currency system and to have a completely different sort of methodology and system for finance imposed when this really does hit the fan. But I think in the interim, a lot of people are going to be pretty much wiped out by what seems to be the storm that seems to be brewing.
There's also another chart I'd like to show here. Let me see if I can pull it up here. It is the gold to oil ratio and oil prices. In the 1970s, we hit a oil crisis I would say midway through beginning, which was the United States hit peak oil in the 1970s. And what we saw here in the gold to oil ratio is we saw incredibly low valuations of oil in relationship to gold. We had that negative price problem with the shutdown. And one thing I'm just trying to wrap my head around is we have an energy crisis that's going on just like the 1970s. And this is just more evidence lining up for a 1970s type of event. And to really get inflation moving and sustainable, the floodgates can be open, we'll call it, from the residential real estate sector going into an expansionary phase. But the oil price is where everything basically leaks and infiltrates. It's inflation everywhere. And that problem that we had with the shutdown caused oil companies worldwide to reduce investment into oil. And we are seeing reduced investment into oil be sustained over time because of ESG, an ESG movement. So looking at the oil price, and I've got the ratio here, this is the big problem in the 2020s, and you can see the anomaly in their ratio in 2020, where it shot above, I don't even know how high it got, above 100, where 100 barrels to 1 ounce of gold. And we're compressing that ratio back down, and where I'm probably going to go where this star is at, below a 1 to 10 ratio, which means that oil has a lot more to compress against gold. And if you look on the right-hand side, this is the oil price in dollar terms. You can see the big, large pattern here. We're breaking to the upside. I've got the projected move. It's just the size of this guy here. I just threw it on top. Maybe it's 160. I don't know how accurate that is. I don't really like doing too much in projected moves. But the key point here is we broke the pattern. We have an oil ratio that to incredible lows. And usually when you go to incredible lows, eventually it works its way to incredible highs during a expansion phase of real estate. And what I have on the bottom here as well is gold. And we've got a gold price. I just threw a nice simple chart. I like the simple things. I don't like trying to get too complicated. But the big picture view on gold looks absolutely fantastic. And gold usually lags the oil price. And you say, well, why? Well, oil moves on up. It's going to move up probably to some ridiculous amount because of investment and what happened during the shutdowns. And that price going up is going to feed itself into producer price index prices, into consumer price index prices. And what we're going to see is we're going to see all of these charts start to align for higher prices in commodities and precious metals. Precious metals are just lagged a little bit because they follow more of the inflation path. As you saw in the other chart, that inflation lags the M2 money supply. So what gets hit first is usually energy. You have an energy crisis in the beginning. And then that energy crisis raises the price of energy, which is the feedstock and inputs of all your manufacturing, agriculture. It doesn't matter what it is. It's the feedstock to everything. And then it works its way through the PPI, CPI, and raises the price of everything. And that's when gold starts to account for all this, and silver and other precious metals. And the opportunity here, we've got an incredibly cheap XEU gold ratio. And the historical norm, just looking back in history, let's just say it's 0.25. And it's just an arbitrary number, the index here, this ratio. But what's important is it's incredibly cheap. This is the gold and silver index in relationship to gold itself. And what we're seeing is we see this kind of, almost we'll call it a descending wedge pattern. It kind of broke out, did a false little breakout to the downside, broke its downtrend to the upside. And we're starting and trying to put in what is a higher high, which would by definition be in a new uptrend if we break this here any second. And I think we're in the beginning, even like as we speak, of gold the gold and silver mining companies moving to the upside and potentially breaking this ratio here at any second. So when looking at the similarities between the 70s and today, with an energy crisis, with an expansionary phase, with the demographics, with all of these things tied together, with the CRB index against stocks ratio breaking to the upside, with these charts of gold, oil, the XAU to gold ratio, which looks like it's going to break to the upside, with platinum breaking to the upside of these patterns as well, with natural gas breaking its pattern, with the uranium to gold ratio breaking to the upside, drawing in a chart line if you have a chart here, moving to the upside, with the uranium price breaking to the upside, with the copper to gold ratio, which I put in here. This is the longest downtrend ever broken, is what I've got here. I can zoom in. Since 1971, we've been in this downtrend line, kind of chilling out for the copper to gold ratio. And this is breaking to the upside, which means we could see a very large move. And you can see in that. And then we've got the gold price priced in dollars, just to show you a long-term picture of this. And then the 10-year treasury bonds, which looks like it, as at any point, wants to go higher. Now, will they allow it to go higher? I don't know, but that puts it at the opportunity for the largest real negative yields that I've ever seen if they somehow hold down interest rates and let this inflation run.
Well, that's a fascinating point, isn't it? Because if they don't hold interest rates down, then that's a whole lot of other problems, associated with that. Interest rates have tried to break out on a couple of occasions, but sort of looking at the technical analysis charts, it's almost as though they've just been kind of hammered back down, because if they're allowed to rise any higher, then, the question of ability to pay national debt comes into the equation. But the more time goes by and the greater the inflationary pressures, it just feels like a pressure cooker that's about to blow its top.
Look, man, I just want to make sure I understand this correctly, Andy. So the gold to oil ratio is coming back down and wants to compress. It seems that it wants to go to that bottom rail. So that means gold is going to outperform oil. Oil is breaking out to the upside and has that measure move going up. And then the gold stocks versus gold are starting to break out. So if oil's going up and gold's supposed to outperform oil, that means gold's going to go ballistic and the miners are going to go even more ballistic or outperform. Remove the move, like the emotional word, ballistic. But the gold miners should outperform gold, which should outperform oil as that gold to oil ratio compresses to that lower boundary of that rectangle.
So what I think is going to happen, and obviously this is all speculative looking forward, is I think oil is going to outperform gold in the short term. Oil is going to continue to go on up for the duration of the commodity bull market and expansion phase in real estate. Then when that starts to decline, I think gold's going to just go ballistic. And it depends on the confidence of people as well. So gold's going to go higher, but oil is going to be moving at a faster pace. If that makes sense.
So I misread the gold to oil ratio as it goes down. That means
oil's
outperforming gold.
As it compresses, that ratio is at 1 to 100 barrels to 1 ounce gold. It's compressing lower to 50 to 40 to 30 to 20. And that ratio is coming back down. I think it could go maybe even below 10, it has in history, maybe an 8 to 1 ratio or 6 to 1.
Then we flip to gold.
Gold will do well. Gold will do well in dollar terms, but I think gold will compress against oil when we have a problem in the real estate market.
Jesus.
So
see Patrick's mind sort of working here, and I get the feeling there's going to be some interesting charts coming out from Patrick over the next few days.
Well, the way that I view things now, if you can see the demographic coming, if you see the shortages in real estate, And if that's the driver, if that is the driver, if you agree with this thesis, if that's the driver, then the charts should all fall in alignment with it because it's herd mentality. So what we should be seeing in the charts, if this were to be a true statement of what I presented here, is we should see the 10-year Treasury bond interest yield, the interest rate, try to go up. I mean, if they're holding it down, if they're in there messing around with it, we should see that trying to go up. We should be looking for a break to the upside. We should see gold firming up, silver firming up. We should see all the commodities start to move higher. Now, there is a wrench in this. It's not, all just blue skies ahead of us. If China has their real estate market collapse, what is that going to do? Because that is one of the larger countries with great demand for a lot of these commodities. So it's a dollar, but commodities are based in dollars. And you have to look to see what the dollar value is, because that's what the interest rate's going to guide money. It's going to guide and flow money towards commodities and away from bonds and stocks in a high inflationary environment with increasing interest rates. So if those are both going higher, money is going to start being guided. It's going to rotate from bonds and stocks into commodities and precious metals. That's what we've seen in the past in the 1970s. Those are the conditions that I would say flourish for the precious metal. At least that's what I've seen in history when looking at history. And then the charts should all align with that, because that's what's driving the herd to create the charts. If you're trying to drive to what I consider to be a root cause of what's causing these people to buy these assets.
Man, I wonder if those demographics are the same in Canada. They probably look like the states, right? Our demographics.
Yeah, and there's another problem as well, Patrick, as well. It's the housing stock in certainly a large part of Europe and the United Kingdom, and I dare say Canada and the United States as well. The sort of wealthy elite part of society, if you like, and the previous generation who've done quite well financially speaking with pensions and all that kind of thing. A lot of them have bought up second homes, holiday homes, condos or whatever you call them over there. So quite a lot of the housing stock in large parts of the United Kingdom is not available for anybody to buy. So there's properties there, but you got people owning multiple properties, 2, 3, 4, 10 properties. During the 1990s, it became very popular to have a portfolio of properties instead of a pension, because there was a problem at the time with pensions, and people were worried about pensions paying out and all that kind of stuff during the financial crisis. So people went to a lot of trouble to build up a portfolio of properties, and that's taken out a lot of the stock as well. So that's going to be a driver for property prices going higher as well.
But yeah, I think the key is the housing starts, right? That's the big teller, because a new start, it means it has to buy new commodities to build that house, right? That's actual money.
Think of it as the inflation. If I were to describe all this, it's the flow of money. It's not necessarily the consumption. So you've got if commodities were priced, they're priced off of two things, in my opinion. It's the inflation aspect, which is the price of gold, because remember, we're using all these ratios. And then you've got the supply demand characteristics. That's the compression of that commodity against gold. That's kind of how I look at it. So I'm looking at this from an inflation monetary aspect. And what's going to happen is if you get the inflation to kick up from the housing starts, the housing starts is new homes coming online, and then they get new loans against those homes. In a fractional reserve lending system, they hold only a fraction of that reserve back. But that new loan that went against the new home is 100% creation of money. It's not like a home that was a loan that was against an existing home, which had a loan against it, which would only be a small delta of whatever that home price went up and whatever the delta is in terms of that loan being made against that house. The new house has a 100% new loan, which is a credit expansion in the system. So what you would see if you want to verify all of this information is look at the areas and what the areas in the world or countries in the world that have large demographic expansions and look at their interest rates and inflation. Look at Japan, which had a demographic that was basically declining. And what did their real estate market do? It declined. And if you were to pull up the Japanese real estate market, they had a little blip in the real estate market and their interest rates went up a little bit during that time frame. I mean, it's like it's almost to the T how this demographic drives the real estate market, and then the real estate market affects the interest rates. Now, interest rates affects money flows of where that money wants to go. It basically awakens, if you have higher interest rates, it awakens the bondholders and say, we can't own these bonds. They're going to go down in value or in price. So they say, get us out of bonds, move it into something that's an inflation hedge. Where are they going to go? They run right at gold, because that's kind of the other measurement. And what have they done in the past? Look at the 1970s in that same environment. It's a rising inflationary environment and a rising interest rate environment together, and gold just went ballistic. It went up 25 times.
And you've seen it every time gold's had these rushes, the capital flows towards gold. The stock market went sideways. So in the 60s, for 10, 20 years, it went sideways. 2001 to 2011, the markets went sideways, right? Crashed. 2008, tried to go back up, and it crashed in 2000. So yeah, that could be, that's my envisioned scenario. So as soon as those ratios really start turning up, of the gold versus the Dow or gold versus NASDAQ, then we know the flows are really they're going towards the new direction, right?
100%
Jesus, and
right.
Andy, man, it's we're gonna have to have you on again, man. It was so much fun.
Yeah, it was a pleasure doing this.
And thank you very much. I was just going to say thank you very much, Andy. I mean, you've given us a lot to think about there, and putting all these pieces of the huge jigsaw puzzle together. It's it's like just watching this image kind of taking shape in front of our eyes, and it's always fascinating to listen to the perspectives from different guests. So really appreciate you coming onto the show.
Yeah, thank you for having me.
All right, guys, and we're going to put the link to your YouTube and your Twitter in the description of the video, so folks could go and subscribe there and follow your great work, Andy.
All right, thank you.
All right. Take care, Andy. It was a lot of fun, man.
Cheers.
Yeah, thank you. Thanks for having me. Bye.